Hi guys, Aaron Fragnito here, back again with another video from People's Capital Group. Hit that subscribe button, hit that notification button. Every Friday, 8 a.m., new video about real estate investing. So we're located here in New Jersey. What we do is we buy apartment buildings, we renovate them, we get them leased up for top dollar, and then we refinance over time. That's called the buy, renovate, refinance strategy, or the BRRR, as you'll see it on biggerpockets.com. And I'm going to explain to you why we do the buy, renovate, refinance strategy instead of sell, okay? Now we do buy and sell residential real estate. I flip houses, I wholesale houses. That's different. In residential real estate, it's you make your money in the transaction, you make your money when you buy and you sell. We flip houses, residential houses, a lot. I'm talking about apartment buildings today. So the reason why we buy, renovate, and refinance out of anything 6 units or bigger, because we believe those cash flow well. Anything 6 units or less, we tend to just flip, okay? I mean, here's why we don't sell them. The biggest reason we refinance over sell our commercial real estate, our apartment buildings, 6 units or bigger, is because of the tax advantages. When you sell a building, you have to do a 1031 tax deference to avoid taxes. That's very hard. We're going to talk about that in a minute. But when you refinance a building, you get cash out of the refinance if it appraises properly and your debt is low enough and you're getting a larger mortgage than your old debt, so there's room in the middle. There's operating cash after a refinance. All right, if a building, you buy it for $1 million, you put $100,000 into it, and over time it appraises for $1.5 million, you can go to the bank and you can pull out $1.25, and now that extra $150,000 of cash after closing costs, let's call it $100, is cash that you can take off the table. You and your partners can disperse that cash. Now the mortgage is a healthy amount of mortgage. It's going to get paid down over the years as we manage the property, buy our tenants. But at that time, once you refinance, you can disperse a large lump sum of cash to your investors. That cash is tax advantage. That cash is debt. So as long as you don't sell the building or sell your share in the LLC, you do not have to pay income tax on that cash from refinance. So when you refinance, you get to keep all your money from it instead of pay 25% to the government. If we sold the building, we'd have to give those profits to the government, part of the profits to the government as income tax. And if you do the 1031 tax deference, there's advantages of it, but it's very difficult to do. The other reason why we refinance over sell buildings is because you continue to cash flow. I look at real estate as a retirement program. The buildings I own provide cash flow and tax write-offs, and over time that just makes a lot of sense just to hold on to them and accumulate as much as I possibly can. So as an investor, our goal is to always continue to build our portfolio. You know, 5 million, 10 million, 50 million, 100 million. Once I'm up to 100 million, the cash flow coming in from the properties, well, I'm just not going to have to worry about money all that much anymore as long as I don't get a crazy lifestyle going. So the continued cash flow, when you refinance a property, as long as you refinance a safe amount of debt, you're taking out an amount of debt. And by the way, the bank won't let you take out more than you can safely take out on property due to debt coverage ratios. But if you take out a safe amount of debt, the property's going to pay that debt down over time, and you're going to continue to cash flow on the real estate. So you continue to get passive cash flow once you refinance a building. If you sell a building, there goes your ATM machine, there goes your cash flow. The whole point of this real estate is to get passive cash flow in the mail every quarter. So we continue to cash flow once you refinance. If you sell a building, you lose that income forever. Okay, the challenges of a 1031 are another reason why we would prefer to refinance over sell our buildings. So the challenges of the 1031, now the 1031 tax deference, when you sell a building and you buy a like or similar building, okay, you have 90 days to identify the building you're going to buy once you sell this building, all right? So 90 days is a very small amount of time in commercial real estate to identify up to 3 buildings you're gonna 1031 that money into, okay? Then you have 180 days to close on that building. So again, it's very challenging to execute a 1031, which a 1031 tax deferred is when you buy a building, you take all the monies from that sale, you put it with a third party, that third party holds the money, and you have to find a like or similar building. You have to identify it within 90 days of what you're going to buy, and then you have to execute within 180 days of that on that building. That's very hard to do in commercial real estate. You can definitely mess up, and then if you do, your whole tax strategy is screwed. So the 1031 tax deference is a great tool. We preach it, we practice it when we do sell a building. Let's say we're struggling with a building, it's not cash flowing as we'd like, or let's say we get a crazy offer on the building and we just can't refuse and we decide to sell it and move into something better. Or let's say we have something on the horizon we really want to put our resources together for and sell some of our buildings that aren't all that cash flowing and cash positive and move it into a better building. We're going to identify a 1031 tax strategy there, and we're going to try to do the 1031 tax deference, but there's challenges to that, there's risks to that, and if it's not properly executed, or you can't close on the building in 180 days, or you can't identify the right building you're going to move into in 90 days, then it's all messed up and you will not properly execute a 1031 tax deference, and you'll owe money on the proceeds of that sale of the building, and you'll get nailed on income tax. So we do like the 1031 tax deference, but there's a lot of challenges and things that can go wrong with it. Where a refinance of a building is a pretty simple process. Banks are throwing their money at us if you have good buildings and good track record. So a refinance of a building has less challenges and quite frankly moves quite quickly as far as getting our cash out of the scenario. Okay, now the non-recourse debt also. So everyone's so scared of mortgages, everyone's so scared of debt. They say, how do you sleep at night with all those mortgages? I may have a $10 million portfolio, but that means I have about a $6 million to $7 million in mortgages. So but it's good debt, okay? Having $7 million in mortgages on cash flowing real estate that's worth $10 million is good debt. The buildings still are positive cash flow, and they still cover their debt coverage ratio easily. So at the end of the day, that's good debt, that's real estate that has safe debt on it, and if you can get non-recourse debt, which any commercial loan over $2 million tends to be non-recourse, then it's basically like you're playing with the house's money. You know, I mean, the bank is giving you the money, you're not personally guaranteeing it. Now, of course, you have to execute properly on it, be a good investor, have integrity, be a good operator, get top cash flow out of the building. But at the end of the day, non-recourse debt that's not personally guaranteed by the operator, is debt that really you don't personally owe back, your company will owe it back. But non-recourse debt is really an amazing tool. It gives you the money to buy a building, to start making income, to build your real estate equity quickly, but you don't personally owe it back. You don't personally guarantee the debt. So if the building goes into foreclosure or there's a big economic collapse of some type or whatnot, you don't personally owe that debt back. So that's called non-recourse debt. The bigger the building you buy, the more likely the debt will be non-recourse. Loans over $2 million tend to be non-recourse. Now, unfortunately, Seth and I work in a market where, in a way, our model, where we usually buy buildings between $1 to $2 million. So a lot of times we are personally guaranteeing the debt, which we don't like. Now, in my opinion, we're going to execute the same way, whether we personally guarantee it or not. So it really doesn't matter how we execute on the property. But as far as just an overall big picture, you don't want to be personally guaranteeing large amounts of debt at the end of the day. You want to try to get non-recourse loans, and if you can, then you're essentially getting money that your company will owe back, but you don't personally owe back, and that's really, really important. So now you can work with the bank's capital to buy buildings and work with your investors' capital to properly execute on the closing and the renovations, but you don't personally guarantee that debt to the bank, so that's a really big plus. And having non-recourse debt allows you to work with ease and not have to worry about personally guaranteeing large amounts of capital. Okay, so by refinancing over selling, you're going to have lots of tax advantages. You're going to keep more money. You're going to give less away to the government. You're going to continue to cash flow on the buildings over time. And as you accumulate a portfolio of real estate, that cash flow gets better and better and better. There's challenges with the 1031. You have to identify the building quickly. You have to close on it quickly. If you don't do that right, you can get nailed with taxes. So by refinancing, you avoid all the headaches of doing a 1031 tax deference and trading up to a bigger building, although that can be a good strategy if the building's not cash flowing. And then of course non-recourse debt. If you don't personally guarantee the debt, then debt really is quite safe, okay? As long as you have no more than a 75% loan to value on the property, meaning you're not going to borrow more than 75% of the property value. The building's cash flowing, is fully occupied, it's well managed, therefore the debt will get paid down over time. If you don't personally guarantee that debt, it's even better. So by refinancing, by using the bank's money to make more money, you really are going to just be able to build your portfolio faster, get better cash flow, and we right now with the interest rates where they are, money is so cheap, money's practically free. The cost of money is somewhat equal to inflation, maybe off by 1%. So money's practically free right now. Compared to inflation, you're paying like 1.5% over inflation for money right now. So take advantage of that. Refinance your real estate, buy more real estate with that cash. Don't go on a vacation with that refinance cash, but refinance and use that cash to build your portfolio, and over time you'll have an incredible portfolio that will provide passive cash flow to improve your lifestyle and your family's lifestyle as well, and build a legacy. So if you want to learn more about how you can do that, go to peoplescapitalgroup.com. We buy apartment buildings almost every quarter here at People's Capital Group. We have our own management company in-house. We also have a residential division that flips properties. We have seminars, we have webinars. You can check out our real estate meetup on New Jersey Real Estate Network on meetup.com. And if you want to participate in an upcoming syndication, you go to peoplescapitalgroup.com, and there you can apply to see if you qualify as an investor. So guys, my name is Fragnito. The site is peoplescapitalgroup.com. Please hit subscribe. Please hit that notification button. Join us every Friday 8 a.m. for a new video. Thanks a lot.